spotlight on DCB Bank as well, which reported its earnings, and it was quite a strong quarter coming in from DCB Bank, with PAT up nearly 20%, whereas NII, that rose about 17%, supported by healthy interest income growth of nearly 22%. However, pre-provision operating profit, that also jumped 59%, though provisions rose sequentially. Now, to discuss this further and the outlook going forward, let's get on board Praveen Kuti, who's the MD and CEO of DCB Bank. Hi, sir. Thank you so much for joining us today. Very good morning to you. Let's start by talking about the results. Now, your PPOP, that has increased significantly. If you could help us understand what were the key factors that drove this kind of increase?
So, this is what I want to tell you is Q1 is generally a soft quarter for banks in general. We're very happy to see the top line growing by 20%. The NII has grown by 16.7% YoY. And the fees have grown significantly. Both the core fee income has grown 17.5%, and we have had a one-time gains from treasury also in this particular quarter. We're very happy with the revenue growth and the NIM growth NIM maintenance in particular, because during the quarter we've had a 100 basis point reduction in the repo rate in 3 tranches, albeit on different dates, and the impact on NIM we've managed to 9 bips in Q1. So that is one significant effort and result in Q1. Let me pass over the fee part of it because 17.5% probably is normal growth, and the one-timer is probably, we may have few more one-timers, but it's not something which you're relying upon. But if you were to look at the costs, we have come down. The cost-to-income ratio has come down to below 60% in Q1, and that's a 700 basis points reduction as compared to the same ratio a year back. So, and this primarily comes from productivity gains and technology adoption. So very happy to see that, because the real gains which we would see progressing in the future as well. There's a tight rein on productivity, and increasing tech adoption is resulting, apart from the turnaround times and a reduction of paper and reduction of errors, also in reduction of cost. So that has led to a PPOP of 327 crores, which is the highest ever in the history of the bank, and usually in Q1 you don't have that kind of an increase happening. So all in all, it's been good. We also taken a conservative view on provision. We have accelerated our provisions on certain key segments, on MFI and on unsecured DA, small books both. And despite taking the accelerated provision, we still have a bottom line, which is 20% growth YoY.
Good morning, this is Ankita also joining in. Let me take a cue from what you just mentioned about the provisions. Your provisions have increased by 71%. Any hiccups that the bank is expecting in the coming future?
So we have a microfinance book. It was 700 crore in the beginning of the year. It has come down. We have taken a conservative view of providing for MFI exposure, which has become NPA. As of March 31st, 2025, we've taken a full provision coverage on that, and also on the unsecured DA that we have, because currently what we're seeing is that there is stress. There is a marginal improvement in the NPA performance of MFI segment, but again, it's marginal. So we thought it is better to be conservative and prudent and take accelerated provision on this particular book.
All right, Praveen, like you said, there is some stress. So, talking about the outlook, from which quarter do you think we can expect margins to hit that 3.2% level as per your guidance that you've given?
Right. So, out of the 4 key leverage variables which we have on ROA and ROE, I think we got a decent handle on fees, a good handle on cost to average assets. For 5 quarters, it's been coming down. And in provision, our belief is, while we have been conservative this particular quarter, we should see normal service resuming in quarter 2, quarter 3, and quarter 4. Normal service, I mean, we've given a guidance of 45 to 55 bips. I presume that it will be in the region of 40 bips, maybe between 40 and 45 bips going forward for the rest of the year. So the only question mark is on the NIM front. We are at 2.99. 3.2 is where we want to be. There's a lot of work happening on the cost of fund part. If you've seen between quarter 4 and quarter 1, we reduced our cost of funds, both cost of borrowing as well as cost of deposits, by 16 bips. Do you see that continuing? 100% yes. We're working really hard on ensuring that there's a tightening of cost of deposit and cost of borrowing, while continuing to maintain growth rate at the current growth rates. So the challenge before us is how do we get to 20% growth and keep driving the cost of deposit downwards. I'm very confident that this is a process which has started. And the reason I'm telling you this is because a large portion of a book is term deposits. And any action that you do on a term deposit results in long-term benefits, because on an average it's a 14-month, 15-month term deposit. So by the time you realize the full gains of a reduction in the rate, 4 or 5 quarters have gone. So every passing quarter, you will find that our cost of funds would be on a downward movement. For a minute, if you were to assume that there are no further rate cuts, one doesn't know about that, but assuming that there are no further rate cuts, I would tend to think that we would have an uptick of NIM in Q3 and Q4, and thereabout, and thereon.
Also, the bank has introduced the SME loan segment between 3 to 10 odd crores in 6 cities. How is the traction going on in this segment?
Oh, we're just hiring the right kind of people, both in terms of sourcing and in terms of credit. We are seeing that we are losing a lot of good SME customers because their needs are increasing. They've been with us for a very long time, and we don't have a product in that particular category. So it's important, not just from a retention perspective, it's a good market to be in. And the critical part is that we will continue to be in the secured segment. If you were to look back maybe 7-8 years back, the 3 crore loans that we gave 7-8 years back, just by inflation alone, the same customer would not have a proper exposure with us. So I thought it's important for us to fill up that gap. I would tend to see that as an investment into the next 3-4 years, the benefit of which will come in 26, 27, all the way to 30. But that's a big segment. We are really betting on it, and we'll see big movement happening on that. It'll still remain an urban product. There will be higher focus on manufacturing coming in there, and we think that's an important cog in our asset wheel. The other being educational institution funding. So these two are very important from a new business perspective, and that should hold us in good stead in the next decade to come.
All right, so let's see how does that SME loan segment and the education funding loan segment pans out for you. But thanks so much, Praveen, for joining us today and weighing in on your numbers and the outlook going forward. On that note, we'll let you go. Thank you so much for joining. Okay, well.